This video is about the different student loan types, and I want to give a very basic explanation as to why student loans have to be consolidated if, number one, borrowers want to get access to income-driven repayment plans, as well as President Biden's newly funded income-driven repayment waiver. I'm going to break down, I have a presentation that I'm going to go through that'll break down the student loan buckets. I put them in buckets, different loan types into buckets. And then I have visual graphics on what loans require consolidation and why they must be consolidated. Okay, so I'm going to shrink my face now. The income-driven repayment waiver is a huge benefit I'm going to present now, to borrowers. And it's a huge benefit because borrowers can get up to 3 years of payments in forbearance, as well as this payment pause time counted towards loan forgiveness. It's not just a benefit to to public servants, but private sector employees can also benefit. And there's 3 buckets of loans that were issued that were federally backed. Direct loans, which are the majority of loans given now. Family educational loans, which were issued before 2012, that were held by private servicers, but the money was given by the government. And then Perkins loans, which were a special kind of loan given to exceptionally high need students that were also overseen by private servicers that were given special college level authority to give these loans. The last Perkins loans that was given was in 2017, so they're no longer given. So just to have you understand, also after 2012, President Obama moved all servicing and funding of student loans over to federal student loan servicers. So we had a complete shift of how student loans worked, and as a result, we have these different types of student loans available to borrowers. And the reason consolidation has to happen with family educational loans, federal family educational loans, FFELP loans, and Perkins loans is because they may not be held by federal servicers. So the act of consolidation is the act of moving those loans over to a federal servicer. And that's why consolidation needs to happen. There's a misconception that consolidation is something a borrower does to get a better interest rate. It's something a borrower does to I'm going to move my face over here. It's something a borrower does to get a better interest rate, to make their loans into one loan, to like other benefits that are just simply not true. Consolidation is only an act that needs to take place in order to turn non-direct loans into direct loans. That's the only reason somebody should consolidate that we'd recommend. Because outside of this income-driven repayment waiver, consolidation can actually hurt you normally because it will start your loans all over. Like all the payments you've made in the past no longer count. And that was the way consolidation used to happen. Right now, there's a benefit to consolidation just because Biden funded the income-driven repayment waiver program that will allow you to get all your prior payments before consolidation counted. And that's the only reason we're actually recommending consolidation. In a normal environment, we would not recommend consolidation so frequently. So now that I've explained that, now let me explain, there's different loan program types. They're called by other things. I'm not going to go over this so much. Just know that if it's a direct loan, it says direct loan. If it's an FFELP loan, it'll say it in front, whether they're unsubsidized, subsidized, whatnot. That's not as important. Okay, so let's talk about the different types of repayment plans people can go into. Once you graduate, the automatic repayment plan you're put into is a no subsidy level payment. That means you make the same payment over 10 years and then you're done paying. That's how it works, right? Then there are plans that are based on your income. They're called income-driven plans. Those require recertification year over year. You don't recertify and prove your income. The point is it's called an income-driven plan. Without your income, they cannot continue to put you in that plan. That's the purpose. And then, of course, there's no subsidy graduated plans. We do not recommend those because the payment increases every 2 years, and we found that by the 6th or 8th year, people can no longer afford those payments. And that could be highly detrimental to then enroll in some other plan and start all over again. And you've ended up paying all this extra interest. It doesn't make any sense, okay? So I'm gonna talk a little bit, I'm not gonna go over the specific plan types for the purpose of this video, but what I do wanna talk about is how loans are moved into repayment plans. Automatically, like I said, direct loans automatically go into level no subsidy, okay? That's what happens automatically. You can always move no subsidy into income-driven repayment like this. Let me show you. I'm going to skip a couple slides. Forward. Literally, you can go from no subsidy to an income-driven plan without an issue. That does not require consolidation. It's just an application. It's something that LoanSense helps borrowers with, right? That application also most frequently reduces people's payment and also improves people's debt to income in order to buy a house. Those are some huge benefits. It also, if somebody loses their job, they can get a $0 payment. Those $0 payments also count towards loan forgiveness, not just public service loan forgiveness, but private sector 20-year, 240 payment loan forgiveness as well. Okay, that can be done without consolidation, without anything except for not a piece of paper. It's more complex than that. It's several pieces of paper filing into the income-driven repayment program. Then if you don't file into the income-driven repayment, if you don't file your income annually, which we help remind borrowers of as well as servicers remind borrowers, then you're automatically put back into the level plan. But the problem with that is all the interest you didn't pay for that year will capitalize, which means will be added on top of the principal, and now the interest will be counted on top of principal plus interest that capitalized. That total aggregated amount will now be all compounding interest instead of just the principal. So that's an explanation. That's why we want to help borrowers avoid going back from income driven back to a level plan, because that will cause capitalization and then more interest will accrue daily, right? So that's harmful. We want to help borrowers avoid that. But if that were to happen, a borrower can still go back into income driven and still pay based on their income. So there is some harm, but not irreparable harm or something like that. It's not like they're defaulting on their student loan or something horrible like that. But we just like to explain that so borrowers understand. And then I want to talk real quick if, for example, I only circled family educational loans, but I'm going to include Perkins loans in this. You hear my son in the background, by the way. Apologies. Family educational loans and Perkins loans, I'm bucketing both of them together because they're both issued and managed by private servicers. Those have to be consolidated. This is what consolidation is. It has to be consolidated and moved to the direct loan bucket. It needs to now be a direct consolidated loan before it can be moved into not a no subsidy level plan. This is a mistake. Let me actually correct the arrows. This you can get automatically without consolidation. The point of this is to move it to an income driven repayment plan. This is now a plan based on your income, okay? I'm correcting the slide. In order to move family educational Perkins loans, it has to be consolidated into a direct loan in order to move into an income-driven repayment plan. I know we haven't talked anything about refinance into the private sector, which I'm going to go over now. Okay, private sector loans. So I want to talk about the difference. I talked a little bit about why consolidation has to happen, right? People always confuse, there's three things that are happening, and I think this is on the next slide. Give me 1 second. The slides are not moving. Okay, let me just go through real quick. What's the difference? Okay, so again, like I said, these can automatically go into no subsidy, or they could be refinanced in the private sector. In order to move them into income driven repayment, it has to go through consolidation, the arrow I just showed. Now it goes like this. That's the illustration I wanted to show. But now let me talk real quick about private sector loans. That's what I was getting to. So there's the concept of consolidation, which I explained, this motion here. Refinancing, okay? So people say, hey, LoanSense refinances people's student loans. No, we don't. Refinance is the act of taking private loans and moving it, federal loans and moving it to the private sector. That's refinancing your student loans, okay? The issue with refinancing of the private sector, there may be benefits like a lower interest rate, but if you end up paying off way less than your principal plus interest, some people even pay a negative interest rate, as in they actually pay back less than what they fully owed on a 10-year level plan. That's a negative interest rate. In refinancing, you might get what appears to be a lower interest rate, like instead of 6, you might get 5.5, but there is no such thing as loan forgiveness. There's no protections against losing your job. You lose all those protections by privatizing your student loans. That is what refinance is, taking public sector loans and turning them to private sector loans like Sally Mae. That is, and there's also way more aggressive interest rates and adjustable interest rates loans in the private sector that are dangerous, because one month your payment might be based on 8%, then literally the next month it might be 13%. It's crazy. Like Sally Mae, that's how they work. That is the act of refinancing, literally turning any of these loans and moving them to the private sector. That's refinance. What LoanSense does is we help people mostly get into income-driven plans. We help people essentially restructure their student loan payment, and we try to do it without consolidation if it's unnecessary, but we structure people's student loan plans. That's what we do. We do not refinance because we don't privatize them. We only consolidate when necessary based on how we explained it in this video. We never have to consolidate direct loans. We don't consolidate to make for fewer loans. Let me explain one really quick thing. It's really important based on when a borrower took out their loans, what type of loan it is, and that determines how people should consolidate their loans. Like people might have Parent Plus loans. Parent Plus loans should not be consolidated and mixed with undergrad loans. And the reason is because Parent Plus loans qualify for only one income-driven repayment program. It's called income contingency, and the requirement for what you have to pay is higher than other loan programs. So we don't want to mix them together because then you have to make a higher overall payment. So it's really important that people understand how to consolidate their loans even, okay? And so that's my last spiel on consolidation and what the differences are. And so to recap, why is this, just to recap real quick, I'm going to enlarge in my face now, is why this information is important is because consolidation decisions need to be made carefully. They should not be made willy-nilly because it is literally restarting all your loans over. Like it's literally taking all the payment history you've made and now moving it to, it might even move servicers. You can decide that in the consolidation app, and starting over. So it is a serious decision, but because Biden's administration has rolled up what's called an income-driven repayment account adjustment program that will allow you to count all your prior payments, it is important to consolidate right now, and it has to be done before May 1, only for loans that are not direct loans, in order to enroll them into income-driven repayment, okay? And then as a result, all the prior history can still be counted right now because of this program. That's why it's important. Income-driven repayment programs are important in general because they do help borrowers manage their payments month to month so that they can continue to afford them and avoid default. And then my final note, why a person may consolidate may also be to get out of default, but there are other options to get out of default, including student loan rehabilitation. I'm not going to talk about all that in this video because it's already at 14 minutes, but I did want to explain what is the difference between restructuring your student loans versus consolidation versus refinance, okay? And I hope you understand now the different types of loans and why consolidation needs to happen, because we get that question all the time. Like, well, people think, oh, I consolidated my student loans. Like, they use consolidation as like that means I'm properly managing my student loans. And that's not true. Consolidation is only an act to turn loans into direct loans so that you can qualify them for specific repayment programs. But it does not necessarily mean you're making the right decisions around what student loan programs and what is actually happening post consolidation, right? And then, of course, it's also really important how you consolidate the student loans. And I hope you understand the differences now between refinance consolidation and restructuring, and when it may be needed based on the original type of loan that was taken out.